Good afternoon, everyone. Thanks for joining. I'm Julie Treppa, and I'm a tax attorney, and Matt Lewis, I'll let him introduce himself, but my partner and I, kind of got interested in this area, last year. Obviously, when COVID hit, there was a lot of people who were facing hardships, and this program came out. And it was very new for nonprofits because nonprofits presumably were not eligible for SBA loans before the enactment of the CARES Act. And so some of the restrictions and regulations were very new. And both of us have worked with clients in this area, and regardless of the fact that this program is almost a year old, find that there still are lots of questions. And so we're happy to try to answer some of those questions today. We're going to give you a little bit of kind of general rules for the program, and then go into the history of the few different acts that were enacted as part of the PPP program, and then kind of get to some specifics for nonprofits, and then we'll have some Q&A. So I'm going to hand it over to Matt.
Thank you. Next. So Margaret, who you saw earlier, who is our kind of hyper smart and hyper organized facilitator of these things, said that we should have some visuals to punch things up. And we couldn't really think of anything except that finally last night it came to me, the perfect visual right there. And that sort of explains how I got involved in this. My background is as a commercial lawyer, particularly a lot of commercial finance. I do a lot of workout work and the like. So when things began to shut down in mid-March of last year, of course, I was very concerned for my clients because they were suddenly facing both for-profit and nonprofit. They were facing complete shutdown of their operations. And when the PPP came along, that was just a lifeline. And it was and we try to get on top of it as best we can very quickly and help our clients through it. And of course, it's been quite an adventure because, as Julie said, this is a constantly evolving program. And even to this day, there are a number of questions and ambiguities about it. And in fact, that's going to inform how we are presenting this today. The payroll protection program is essentially, it's more evolved. They've gone through sudden changes over the course of the last year. So there's a lot of continuity, and it helps to understand kind of the basics of it. And then many of the changes that have taken place have been largely in reaction to some of the perceived problems that the PPP program has had as it's been rolled out. And so again, seeing those changes in those contexts, I think will be helpful to understand them. So what is the PPP program? I think one of the most important things to understand is that the focus is on payroll protection. It's right there in the title. Remember, this was a hastily passed piece of massive legislation as part of the CARES Act in late March 2020. And they were reacting to a perceived danger of a complete collapse in business, a complete lack of liquidity, which would lead to mass unemployment. And of course, we have a consumer-driven economy, so mass unemployment tends to spiral on itself. And so the thought was, well, let's find a way to prop up payrolls, help businesses get through this when there's no demand anymore, and see how we can come out on the other side. And both the haste in which it was enacted and the focus on payroll protection, I think both of them tend to inform a lot of the features of the program and also inform kind of a lot of the issues that have arisen from it. You could ask yourself, has this program been successful? And I think it's fair to say it pretty much, together with the CARES Act, the other pieces of the CARES Act, has in many cases. We've had, I don't want to underplay the amount of unemployment we've had, but in fact, a lot of businesses that you would not have expected to have survived such a shutdown survived it. and kept people on payroll for a lot longer than businesses otherwise would have, or kept them on throughout. And in that respect, I think it's been truly a lifeline. And some of the features of it that contributed to this this beneficial result is, first of all, it's big. There's been close to $800 billion worth of loans allocated. Last I checked, there were about 140 million were still available for first and second draw PPP loans. The PPP, as Julia alluded to, is administered through the Small Business Administration. There wasn't really a quick and easy method for Congress to provide payroll support directly to people who might otherwise be under or unemployed. So instead, it was through the guise of the Small Business Administration. However, the Small Business Administration is intended to be a lender of last resort to truly small businesses. And so that made it important. That made it necessary to expand the class of small businesses to a lot of businesses that you otherwise would think are medium or quite large-sized businesses. Essentially, businesses that have fewer than 500 employees are eligible for the PPP. The amount that can be borrowed is most of you know, it's 2.5%. I mean, 2.5 times average monthly payrolls, either average through 2019 or through specified periods in 2020. Now, there is a cap on individual salaries. This was not intended to support truly well-off people. And so there's a cap of $100,000 on cash salaries, although you can still use the PPP to pay benefits, non-cash benefits. Next, please. One of the features that's got everyone's attention, of course, is that the loans are forgivable. And they are generally forgivable if the funds are spent for what are called covered expenses during what's called a covered period. And a lot of the questions we get and issues have arisen have revolved around exactly what's included in both covered expenses and the covered period. Because it is a payroll support program, this forgivable amount is subject to reduction to the extent payrolls have been reduced during the so-called covered period. So that's an important piece of bookkeeping there. Now, there are exceptions, there are grace periods and like in there, but that's the basic concept. And even if you don't qualify, or to the extent you don't qualify for forgiveness, the interest rate is quite low. It's 1%. So it's still a very helpful program for a lot of businesses, again, nonprofit or no profit or for profit. Now, other features that might be interesting are the fact that there's no collateral or personal guarantee required. That opens it up to a lot of borrowers. It does not need to be a last resort loan. The SBA is traditionally lent to businesses that can't find funding elsewhere. That's has nothing to do ostensibly with this program. And finally, talking about covered expenses, this is going to be a theme running through it. Covered expenses includes payroll, interest on mortgage and other unsecured secured loans, utilities, rent, that kind of thing during the covered period. Now, recently, we're going to see this list of expenses has been expanded, but the focus will continue to be on payroll. Next. Margaret, thank you.
So the first act that, originally the CARES Act was enacted, and that was kind of our first enactment of the PPP loan program. And there's no other word to describe it except utter chaos when it first came into play. It was very quickly pulled together by Congress. I quite frankly remember looking at it on a Saturday morning. It had been enacted on a Friday afternoon and trying to get through it on the weekend to just get up to speed on what was going on. Because what we were told is that there was a specific amount of loans that are available, and it was just going to be allotted on a first come, first served basis. So from our perspective as attorneys, we had to get up to speed very quickly because our clients were going to want to be first in line. And, Matt kind of came up with this phrase. It was really a stampede to the teller's window. Everyone was encouraged to apply, but the lenders were not prepared. There was no real regulations for them at first. And people might recall at first some lenders said, we're not going to participate in this program. And that was a lot of major banks saying they weren't going to participate. And I'm told, I don't know if this is an urban myth, but that Mnuchin personally called a lot of CEOs of the larger banks and said, oh, yes, you will participate in this program. So, originally it was very unclear what to do. Lenders didn't even have application forms available. And it was very ambiguous how to apply, what was eligible. And, partnership, could you include partner expenses or should partners individually apply? There was all sorts of different theories out there on how to go about this. And what wasn't helpful was that the SBA did start issuing these interim rules, but virtually every day they were changing them. So it was very hard to say we had this list of regulations that we could all follow. But eventually we did get some rules to follow. People got their applications in. And as Matt indicated, he kind of went through the basics of what those rules were. So next slide, please.
I think they still are interim final rules, which is almost Orwellian. I love that phrase, and it kind of tells you what was going on there. Julie mentioned the first weekend. And I remember she and I and a couple of other people who are focused on this were constantly exchanging emails. This is what's going on. No. This is what's going on. No. You've got it completely wrong. And we're pretty good at this. So I can't imagine what it was like for everybody else. It was just a thoroughly chaotic situation, and that's led to a bunch of issues. And I'm going to break them down into a couple of places. And again, they continue to have echoes and reverberate to this day. First of all, any complex piece of legislation has got some holes in it, and there were a ton in this that required interpretation. So for example, a lot of the lender responsibilities were not laid out, which made lenders very reluctant to participate or able to participate in the effective manner until some of the rules started rolling out. There were tax issues, all sorts of issues like that. Secondly, again, as Julie kind of hinted at, you may either this happened to you or you may remember reading about this, but the people who got to the front of the line stampeding to the teller's window tended to be larger, well-connected, well-advised businesses. So to the extent that this was seen as a support or a prop up for local mom and pop businesses, that wasn't what the headlines were showing. They were talking about the Shake Shack or the LA Lakers. And this was seen as very bad publicity and gave the program a bit of a black eye. And this tied into what I'm calling the necessity debate. If you've applied for a PPP, you probably remember that you had to sign a certification that said that current economic uncertainty makes this loan necessary to support the ongoing operations of the applicant. And some of the ambiguity can be found even in the language of this certification: current, uncertainty versus necessity. I mean, how do you know what is necessary if things are uncertain? There's a lot of inherent tension in there. And it did not help that some of the first reactions to some of this news about what appeared to be large, well-funded businesses taking advantage of the PPP, that in reaction to that, the Secretary of the Treasury, Mnuchin, or I hope that's how you pronounce his name, but it's no longer quite as relevant as it was, started giving press releases talking about criminal prosecution. At that point, I know my phone started ringing from a bunch of people. Well, we've got the loan. Do we give it back? What do we do? In response to that, the SBA tried to issue some not terribly successful efforts to clarify what they meant by necessity, and we'll come to that again a little later on. And they also provided an amnesty period where they were basically saying, we understand this was kind of a bit of a mess. If you just give it back, well, it's no blood, no foul. But the issue still remains to this day. It's still unclear what necessity consists of. And there have been some additional final rules and the like and comments out there to try to help that process along. I'm not sure it's been terribly successful. The next set of issues that came up were forgiveness. Again, one of the chief functions of this program, or the chief benefits or attractions, was its forgiveness. However, as initially conceived, it was fairly, it was not as generous or as clear as it might be. It had a short covered period, 8 weeks. You had to spend 75% of funds on payroll. And again, some businesses, that's fine. Other businesses, in order to maintain the payroll they have, there are simply other necessary costs that have to be covered. And this didn't seem to give adequate consideration to that problem. And then what if the business is simply not there? Are you supposed to pay people to just sit? Now, to some extent, the answer is yeah, but that's not completely it. And so, what's the appropriate balance there? And then finally, we have an issue that only recently got resolved, and that is, all right, if you pay covered expenses that you normally would deduct on your taxes, you still get to deduct them. And again, this is supposed to be a tax neutral, or not tax neutral. This is not supposed to be a tax detrimental program. It's only recently that we've gotten some clarity on that issue. So by early spring 2020, whole bunch of issues out there. And in response to that, both Congress and the various administrations now have tried to help. And Julie, do you want to talk about some of that help?
Sure. Margaret, can you go to the next slide? So yeah, I guess actually I forgot we had this. So before we move to the other issue that came up is, there was this public disclosure. So who gets to know that I got this loan? Because as Matt mentioned, it became kind of controversial if you got the loan and you were not a very small business. And so the SBA had originally said, we do have certain public disclosure requirements. We are a federal agency, but we are only going to disclose those borrowers who borrowed over $150,000. We're only going to disclose kind of a limited amount of information. And the idea was, if you're borrowing less than $150,000, because of the formula that's used to calculate the loan eligibility, we might be disclosing some confidential information of that business. So for example, if you're a small business, the way the loan was calculated was based on your net profit. You might not want people to know what your potential net profit was or wasn't. And so this became an issue. But then certain lawsuits arose, and eventually the SBA backed down. And now virtually you can go on this website, which I put the site here in our slide, and you can get a lot of information about what loans have gone out to various borrowers.
And part of the tension here is that if you were participating in this at the early period, you were being pushed very hard to apply for a loan if you were qualified, if you were inquiring about it. Lenders were encouraged to make loans as fast and as quickly and as much as they can because of limited availability. Everyone who was interested was encouraged to get in line as quickly as they can. And so, at least I have always understood, the SBA was trying to be circumspect here so as to not to scare off people from applying for loans, when it would in fact be beneficial to both their business and their employees if they did so.
So again, like Matt said, there was a lot of issues, and Congress wanted to step in and see what they could do to resolve some of those. And initially, the first fix to the program was enacted in April of 2020, and it really was just an extension of the program, of the amount available for the program. There was a lot of controversy about who got loans, who got to the teller's window first. And so there was an additional 484 billion of funding attached to the CARES Act, which about 320 billion was going to go to the PPP program. So next slide. As of June, this is really when the Congress was trying to fix some of the problem. So a real problem for some people was that you had to use a certain amount of the loan proceeds for payroll costs. So it was 75% under the original CARES Act, and this was reduced to 60%. Now, granted, the whole purpose of the program was to keep people employed, so it makes sense to require a certain amount to be allocated to payroll. But given what was happening to a lot of businesses under COVID, tying everything to payroll was difficult because, for example, if you were a restaurant, you may not, are you going to hire people, like Matt said, to just sit around? It doesn't make a lot of sense. So there was this reduction from 75 to 60%. And then there was a fix on what's called the covered period. So the covered period is the amount of time you have to spend this money on these qualified expenses. And originally it was an 8-week period. And so there was a change. There was a lot of concern about whether or not that was long enough. And so there was this change to allow for a 24-week covered period. But under those circumstances, in some instances, you could elect between those, in most instances, between those two choices. Do you want to use the 8-week period, or do you want to use the 24-week period? Because there was a lot of other requirements that were kind of attached to whatever cover period you used. So, we were definitely running numbers for clients under both scenarios. What's going to give you the best loan forgiveness, the 8-week or the 24-week period? It wasn't always to your advantage to use the longer period of time. And then it also allowed for certain other provisions to make the program a little bit more flexible. So definitely there is a reduction in the amount of loan forgiveness that you're entitled to if you reduced your FTEs before the end of the covered period. And so, but what if you had to reduce the amount of FTEs to satisfy certain health and safety restrictions? Certainly, there was provisions that were added to allow you to have, no reduction if in fact you met these safe harbors where, the reduction only took place because essentially you had to. There also, because you had this reduction, if you had a reduction in FTEs, you could avoid having a reduction in the loan forgiveness amount if you rehired those people before a certain date. And originally under the CARES Act, that was June of 2020. And the Flexibility Act extended that to December of 2020, which gave people more time. I think this was a result of people realizing that COVID was just going on longer than they expected when the CARES Act was enacted. There also was a change in the maturity date for the loans. And this is actually a little bit odd because it's the minimum maturity date that the lenders could impose. So originally under the CARES Act, it was 2 years, and this was extended to 5 years. To be honest, lenders had a choice to give you more time if they wanted to, up to 10 years, but virtually no one did that. And then finally, there was some kind of clarification or new rules about loan forgiveness itself. So there's this question, you have to apply for loan forgiveness. You have to kind of get your books and records together. When do I have to apply, and what happens if I don't apply in time? So there was some clarification that you have the deferral for up to a period of time whenever the SBA remits the forgiveness amount to the lender, or 10 months after the covered period if you haven't applied for forgiveness. So basically what this was trying to solve is if you applied for forgiveness and you were waiting, and then pushed beyond that 10-month period, you were fine. You still were allowed to wait, and you didn't have to start making payments on that loan as long as you got that application in. So next slide.
So that takes us through late fall of last year. What's happened since then? I think there have been three major things that have come up that have been important to people. First of all, there has been the necessity questionnaire, which has raised a lot of concerns and frankly should, given it the way it's developed. Then there's been the Emergency Aid Act that was passed in December 27, I believe, of last year. And then finally, now that the Biden administration has gotten in and gotten kind of on its feet, they are beginning to weigh in with changes as well. And a number of these changes are prioritizing small businesses and self-employed persons, and thus mostly procedural changes, but they could have some effect on timing of people in this chat. I want to talk briefly about the deemed necessity questionnaire. I'm going to come back to this when we focus on the more nonprofit specific issues. But as you may recall, there's a certification given of necessity, and as part of its quote clarification, the SBA was saying that the certification was required to have been made at the time of application, even if subsequent developments resulted in the loan no longer being necessary. They're trying to clarify that it's not a backward-looking certification. Nonetheless, the first reaction is some of the public concern about ostensibly unqualified, well-heeled persons taking the loans were, as I mentioned, threats by the Treasury Secretary to review all loans and impose criminal liability under some circumstances. Soon it became very apparent that that was not going to be practical. I mean, the SBA could barely handle the volume of business it had already without hiring hundreds of thousands of inspectors. Then it became, the solution was to say, look, anyone who got a loan under $2 million, you are deemed to have met the necessity criteria. We're just not going to worry about you. Over $2 million, you're subject to review. And as part of that review at the end of October, with some changes up to the end of December, the SBA started issuing necessity questionnaires. These necessity questionnaires are pretty interesting and somewhat alarming in some ways. Supposedly the SBA is issuing these and requiring these from larger borrowers of larger amounts so that they can review the totality of the borrower's circumstances using a multi-factor analysis, none of which is in a statute. This is very much a moving target. And I don't know, is anybody here received or looked at or filled out one of these necessity questionnaires? I can't see everybody on board, but they ask a lot of detailed questions. And a lot of the detailed questions are about the sources and uses of funds during the covered period. The covered period is the period at which you're supposed to be, you've received and are now using your PPP loan. It is by definition after you've given the forward-looking certification. So it's basically looking back after the fact at what happened and was your prediction accurate or not? And so that, by its very nature, I think is raising anxieties with people. Now, it's not completely possible to say what the consequence of these questionnaires are going to be. So if it looks like in hindsight, well, maybe you didn't quite need the loan the way you thought it would, I think in many cases, people will simply have to pay back the loan. It's not going to be penalties or anything like that. But nonetheless, it is a source of anxiety. And if you're thinking about a second draw, it's somewhat of a roadmap for how the SBA will look at you're answering the necessity certification in connection with your second draw. Next slide, please.
So that brings us to the Emergency Aid Act that was enacted in December of 2020. And so these are really the rules that exist today if you are thinking about applying for a loan or loan forgiveness. So one of the things to note is the act did extend another 285 billion in new PPP funding, but the deadline to make the loans is only through March 31st of this year. Now, whether or not that'll be extended, we don't know, but for right now, if you're thinking about applying for a loan, you have a deadline that you have to meet that you should be really thinking about. And a lot of the same provisions for applying for a first draw loan still exist. So we have 2.5, the amount that you can get is 2.5 of your average payroll, 1% loan, no collateral required, everything that we mentioned at the beginning of the program. But there were some significant changes. And one of them was to increase who is now eligible to apply for a loan. So still, we've got small businesses with less than 500 employees, charitable organizations, but there was an extension to certain 501c6 nonprofit organizations. There is a glitch on that you have to have less than 300 employees, nonprofit news media organizations, if they're owned by a nonprofit public broadcasting or receive a certain amount of, not depending on where their funding comes from. There are different, chambers of commerce, destination marketing organizations, although there's limitations on lobbying. Some of the things that aren't on here, tribal business concerns. So there's a lot more people that are now eligible for the loan. And in addition, you have this new funding that's going to apply for first draw loans. And in some instances, I can't remember what they called it, but like you're getting an additional extension of your first draw loan. So in some instances, people got nervous, they gave the money back or they didn't accept it. And so the SBA is recognizing that those people should be eligible now. Maybe they gave it back because the regulation was so hard to follow. And so those people can now get that money back that they turned down. Or in the case of partnerships, there was a lot of people that didn't realize that they could include the compensation of partners, and people can now go back and ask for additional loan proceeds all under their first draw loan, if those were their circumstances. But in addition, and this is new to the Emergency Aid Act, there was authorization for a second draw. So the formula for what you can borrow is essentially the same. It's 2.5 of average payroll, but this time it's up to $2 million. Next slide, please. And it's also, for these second draw loans, a little bit more tailored to small businesses. They can only have no more than 300 employees. You must have used if you took a first draw loan, you have to have used those proceeds before you can apply for a second draw loan. But you don't have to have applied or received forgiveness on your first draw loan yet. And so, prior to this program, somebody asked a question, well, if you haven't received forgiveness on your first draw loan, should you apply for a second draw loan? And Matt and I were talking about this before the program, and we thought this was actually a very good question, because I think that's going to be a facts and circumstances test. If you are concerned that maybe you're not going to pass the necessity test, you're certainly going to know that a lot better after you've received forgiveness on your first draw loan. But you do have this time constraint for which you can apply for the second draw loan. So it may be wise to not wait under those circumstances, because we don't have a lot of time, and then just realize you may have to pay that money back, and just keep that in mind with your financial planning. To get the second draw loan, also, you have to have had this decline in gross receipts of 25% in any quarter in 2020 compared to a comparable quarter in 2019. And this is new, and I think this is also something that's being misrepresented, because you hear a lot of people saying that this applies to the Act in general now, but this only applies to second draw loans. And then in addition, Matt was talking about the financial necessity questionnaire that came out for nonprofits. Under the second draw loan and determining necessity, they're going to look at a lot of the same things that they would look under the first draw loan, and that includes things that, as a nonprofit, you would normally report on your 990, like cash contributions, grants, gross receipts from sale of assets or investments.
Yeah, and in this context, we're talking about it in terms of the 25% reduction. Those all are kind of what you're looking at for gross receipts. But as Julie said, it also comes it's right in the necessity questionnaire. It comes right back to your general analysis of whether you qualify for the loan in the first place.
So then the other thing that changed with respect to the Emergency Act is, what are the costs that you can use the loan for during the covered period? So prior to enactment, as we said, there was payroll, certain benefits, mortgage interest, if you had that obligation in place on February 15th of 2020, rent, if your lease was in place by February 15th of 2020, utility expenses, and there was an expansion to these covered operational expenses, which includes certain software expenses to facilitate business operations, covered property damage costs if there was some damage to your property that wasn't covered by insurance. During 2020, which is a little bit interesting now to think back on what may have happened to certain places in January of 2021, because it does specifically say it has to be a disturbance that occurred during 2020. And certain worker protection expenditures to help keep your workers or the customers that you serve safe in order to comply with, by complying with COVID restrictions or guidance. So are you buying PPE for your employees? Are you installing barriers to protect cashiers? Are you expanding outdoor spaces? Are you changing your ventilation system? All of those now are considered covered costs, but keep in mind that what didn't change is that you still have to spend at least 60% of your loan proceeds on payroll. So even though there's been this expansion of covered costs, you can really only use 40% of the loan to pay those expenses. Otherwise, the amount of loan forgiveness is going to get reduced.
And definitely look into the specific expenses before making a decision. When we put this list together, it was a little bit more illustrative than absolutely complete, because we wanted to have room to actually talk about things.
So next slide. Yeah, I think some of these I was talking about. So yeah, the other thing, there was an expansion of benefits and supplier costs. So there's also, if you had received an emergency injury disaster loan, that also used to reduce the amount that was forgivable. But now you can, the way it's kind of worded in the statute is you can kind of refinance that EIDL loan with the PPP loan. So that no longer reduces the amount that's going to be forgiven. And in addition, there was an additional $20 billion that was allocated to EIDL funding. What you will get a reduction for is there was also a new program that was added, the Shuttered Venue Operations Grant, which isn't a loan, it's a grant for certain businesses that suffered as a result of COVID, but that will reduce the amount of loan forgiveness if you've gotten this type of a grant. Next slide. So those are the basic rules. And as Matt said, now that the Biden administration has come in and said, well, we want to make some changes. We really want to make sure that this program is going to help small businesses. And so we want to ensure that there's a priority given to processing those small business applications. So from, what was it, 2/24 was last Wednesday through March 10th. The only new applications that are going to be processed are businesses with fewer than 20 employees, so very small businesses. There still obviously will be time afterwards to apply and meet the March 31st deadline, but if you do not fit within this definition, you might want to get your application up and ready to go because you're not going to have a lot of time to submit it after this time period expires. They also revise the formula for how you calculate eligibility loan amounts for sole proprietor. So a sole proprietor under the CARES Act was calculating their loan amount based on their net profit. There's a lot of discussion about that because you have a lot of small businesses that have no employees and maybe are not profitable. And are you really trying to not support the businesses that are struggling and having losses? Whereas if you had employees, the amount of loan that you were eligible for was solely based on your payroll costs, and it didn't matter whether or not that business was profitable or not. So this was deemed to be unfair, and so the formula has been revised so that for sole proprietors now, it's based on gross receipts as opposed to net profit. The CARES Act also had provisions that would render certain borrowers or potential borrowers ineligible. And one of these was that if you had I think it's 20% or more owner that was incarcerated or convicted, and I believe it's even if you have been charged with certain fraudulent felonies, or I'm sorry, with any felony. And so the Biden administration has said, we're going to remove restrictions on owners with prior non-fraud felony convictions. They're also going to eliminate a provision under the CARES Act that would not have allowed you to apply for the loan if you were delinquent on a student loan. And then finally, if you are a lawful legal resident, there was a lot of issues about whether or not you could apply. I don't know if a lot of people realize this, but a legal resident often doesn't have a social security number. They have what's called a individual taxpayer identification number so they can file a tax return, but that isn't the same thing as a social security number. So there was some confusion about whether or not they could apply at all. And the resolution was, as long as they're a legal resident, they can apply using an ITIN instead of an SSN. So next, please.
So we've been talking about rules, kind of rules, considerations, and events that apply generally across the board to PPP borrowers, regardless of their status as profit or nonprofit. We thought we'd focus for this portion of the program on areas, at least where Julie and I and other people who work in this area have been getting the most questions from nonprofits. And again, this may not reflect your experience, and we would certainly welcome the chance to talk about issues that you guys are seeing coming up. This is what we're seeing, and they largely fall within two categories. One is, again, this necessity test, and specifically, there's some unique things about nonprofits that make it, in my opinion, even more complex and confusing than it is for-profit borrowers. And then secondly, the forgiveness process and application, because again, like a lot of things with this program, it's not necessarily intuitive. and the details count. So we would like to help you with that as well. So let's talk about necessity for a moment. Again, remember the necessity arises from the certification required in the original application. The current economic uncertainty makes this loan necessary to support the ongoing operations of the applicant. A statement, as we've mentioned before, that has some inherent ambiguity in it. Now, the SBA tried to provide some guidance, some clarity. Borrowers are to take into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. Now, I don't know about you guys. I think that solves everything, and we can pretty much go home now. It is not a huge amount more satisfying than their statement about facts and circumstances and multivariant analysis. What makes this particularly challenging, I think, for nonprofits is that nonprofits get their funding from a whole bunch of different sources, some of which have restrictions that apply to them, and some of which don't, and that they are not, at least a lot of nonprofits are not as dependent on market circumstances as a lot of for-profit businesses. So let's take the first question here, and that is, what if my nonprofit receives grant money? I think you have to ask yourself a bunch of questions like that. I'd be interested if anybody has others, but the ones that I tend to ask and that have come up are, well, how certain is the funding at that time? Remember, this is an uncertainty-based test. Two, does the grant pay costs directly, or does it pay it to the nonprofit who pays costs? If it pays directly, that seems like that's a bit of double dipping there if you're trying to claim necessity. Is the grant restricted in uses that cover what would otherwise be covered expenses under the PPP? This is one of the areas where I see the most confusion there. A lot of grants are for very specific purposes. Some, for example, will fund a specific payroll. Can you claim PPP for necessity for that when in effect you're being covered? I think it's quite clear now, by the way, given some statements from the SBA and others, that to the extent it's the government covering those costs and they're specifically directed, no, that does not count as necessity, because you have a high degree of certainty you're going to get those funds, and they are in fact directed for those specific purposes. Can you take the grant funds and allocate them to non-covered periods so that you can claim that you're using the PPP for the same types of costs, but within the covered period? I think to some extent that is permissible, but it's something you want to ask yourself. And the final question I would ask here is, a lot of nonprofits have a reputation as one of their clear assets. As one of my clients who ended up on the wrong side of this question once asked, the essential question is, what if my mother read about it in the newspaper? What would she say? And unless you're, now your mother may be, Bonnie and Clyde, I don't know, but I find that is a useful way of thinking about it. And that is, if this came out and people looked into it, how hard would it be to explain the decisions I made? Next slide, please. So related to that is the more general question, what if you have a substantial endowment or substantial reserves? Again, I think you have to start asking what the alternatives are. What were your expectations that these would be available and not negatively impacted by the pandemic? What kind of obligations did you expect to incur? Did you initiate any non-obligated capital improvements or start a new mission program that's not responding to COVID during the covered period? I think I think it's a tougher sell or tougher statement to make that this is necessity if I decided to improve my balance sheet by paying down debt. And again, what if your mother read about it? How would you answer that? Now, I have here what I have found a useful way of looking at this is what I call Matt's rule, and I want to indicate: one, this is not the law. Two, I just made this up, but I do find it helpful. And that is, remember, this is a payroll protection program, okay? So if, knowing what I knew at the time that I applied for the loan, how likely was it that I would have planned to lay off employees if the loan did not come through, okay? Uh, I think the closer you get to that standard, the more comfortable you can be in making the necessity certification in terms of your, if you're about to take a first or second draw PPP loan, or answering the necessity questionnaire. And the last thing I want to say in connection with this is, if you look at the necessity questionnaire, I mean, it's fairly rigid. Basically it's a sources and uses analysis that took looking at what actually happened during the covered period. But there are a number of places in which you are invited to add a narrative. And again, if you have facts that may not look perfectly great, but you can respond to the narrative, and you can respond in a way that honors the purpose of the PPP program. That is, in March 2020, I did not think we would have, a theater program if I'm a theater, and therefore I was going to lay off everybody on my staff. It turned out we were able to have a remote theater program. Okay, you didn't know that at the time, and you were focused on keeping those people employed so they could put that program together. That would be a nice narrative to have. That's a good way of thinking about it. Julie, do you want to talk about forgiveness?
I do want to add a little bit. So, I mean, I would encourage everyone to look at the form. Not everyone is going to have to fill this form out. It's form 3510, and you can find it on the SBA website. It does go into a lot of detail. And I would agree with Matt, whenever you have an opportunity to insert some narrative, I would encourage you to do that. I would also encourage you to document there's certain documentation you're going to have to send with that anyway. But if you're documenting kind of your intent and what the facts and circumstances are, I mean, it's always best to have something that you've prepared, at the time, as opposed to later when maybe somebody is investigating this. So if your intent was to get this loan to cover X, Y, and Z because you didn't know you would have another funding source, let's document that in some type of a journal. You may not be able to submit that with the form, but certainly you'll have it on hand if anybody comes back and asks questions. I also would encourage you to talk to the bank officers or whoever at your bank you're working with when you submit your forgiveness application, because they're the ones that are going to see what's coming back and being questioned or not. And they may have some ideas as to how to format that narrative in a way that's going to make your loan forgiveness application successful.
Julie raises some excellent points there. You definitely need to keep records of what you've been doing. And in fact, for example, it would be very useful if you are now considering taking out or expanding your first draw or taking a second draw. What are you presenting to the board of directors or the board of trustees? What considerations are they looking at? That provides a nice framework for analysis. Similarly, even if you don't have to fill out the necessity questionnaire, it tells you what the SBA is looking at and gives you a guide as to what records they will be requesting if this ever comes up. So I fully second the advice to take a look at that. Right now, it's probably the best guidance we have.
So it's great to get the loan, but you want to make sure that you're going to get it forgiven. So, the process for doing that is really to apply to your lender, and they may have a form that they want you to use, but it's all going to mirror the SBA form 3508. And again, you can find that online. It provides a lot of good information and helps you work through the math problem that is what can and can't be forgiven. So the basic rule is that you're going to have to adjust the amount that's eligible for forgiveness under certain circumstances. And the main reduction that we're going to talk about in this slide is there's been a reduction in FTE equivalent employees or employee salary and wages. So there's no reduction if there's been no reduction in annual salaries or hourly wages of any employee by more than 25% during the covered period. And again, the covered period, actually, I think I didn't mention this when I was talking about the highlights of the act. Whereas under the Flexibility Act, you could either choose between the 8-week or the 24-week. Now your covered period begins on the date that the loan is dispersed, and you can choose any date between the 8-week and the 24-week period. So you have a lot of flexibility in calculating these amounts because you have some flexibility in determining what your covered period is when you apply for loan forgiveness. So in terms of determining whether or not there's been this 25% reduction, since it's talking about during the covered period, you might want to run some numbers as using different covered periods. So it's during that covered period as compared to the most recent full quarter before the covered period. So that's kind of your first requirement. You also have to have no reduction in the number of employees or average paid hours of employees between January 1st, 2020 and the end of your covered period. Or there's two safe harbors. One is that you were unable to operate between March 15th, 2020 and the end of the covered period at the same level of business activity. Or, and I should have added this to the slide, or you rehired people, you cured. So you can restore, depending on when you took your loan out, you can restore your FTEs by December 31st of 2020 if you took your loan out before the enactment of this latest act. But if your loan came out after 2027, you can cure by the last day of the covered period. Next slide. And then in terms of, the application, they tried to make it easier by coming up. You'll see the 3508 is very extensive. And in some instances, you can file a short form application. But, I think it is a good idea to review the long form, because at the end of the day, even if you fill out the short form, which may require you to submit less documentation up front, they still can come back and audit you. So, and they make that very clear in the short form application that you need to retain your records for a certain period of time. So whenever you submit your loan forgiveness application, just keep in mind, you are going to have to prove that you paid expenses, you use the expenses on appropriate amounts, and you paid 60% of it towards payroll. You're going to have to submit payroll tax returns, whatever you have to establish that you made these payments. And just like as if you're filing your tax return, you've got to maintain all those records for a certain period of time in case they come back and question your application.
That's us.
So I think we've gotten some questions